From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, January 20th. Here are the top market stories that we are following for you at this hour. Tumultuous tech now turns to Netflix. The streaming giant kicks off big tech earnings after the closing bell. Can Netflix turn around that tech sentiment? And Biden's Russian misstep. President Biden says Russia could opt for a smaller scale incursion into Ukraine, making a cohesive Western response harder. We're going to speak to Ian Bremma, Eurasia Group president. And get back to your desks, everybody. Goldman City asking London staff to return to the office. We speak to the head of another big bank, Brian Moynihan, Bank of America chairman and CEO. From New York, I'm Alix Steel with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets, Guy. It's good to see you. I missed a doozy of 4 days of heavy news flow.
Yeah, I mean, just get the data out of the way, and then I want to talk about what exactly you missed. Housing data just hitting the tape at the moment. 6.18 million is the year-on-year number. That's certainly off the pace. 6.42 is what we were expecting. Maybe signs certainly that A, high prices, a lack of supply, and mortgage rates rising starting to have an impact. That's just something that we want to be folding in terms of the numbers that we're watching. But let's get back to the fact that Alix had 4 days out, and the world changed, I think, in those 4 days, Alix. So what do we have? We had the... I'm not blaming you. I'm just saying it happened.
He is.
You had the NASDAQ correction, so we had a 10% down from the highs. You've got the market now pricing more than 25 basis points at the March meeting, so people are now talking about 50. You've got potentially an end to the bull market broadly. You take a look at what the technicians are saying. Alix, they're getting super excited. I could go on and on and on, but we've run out of time. But basically, please don't take any more time off because it was a little bit hectic, to be honest.
No, I know. When I saw the news flow, I was like, oh, man, Guy's going to be mad at me. There's a bitter work husband there coming at me.
Oh, yeah. And I didn't even mention the fact that the commodities market was absolutely on fire and oil prices were surging higher. That I know you would have been excited about, but I know you were excited about all of it. But yeah, please don't take any more time off. I'm not sure I can do another 4 days like we've just seen. Friday cannot come fast enough. Sarah Hunt joins us now to join in the fray. Sarah Hunt, Alpine Woods portfolio manager. Sarah, Alix has had 4 days off. The world has changed, I think, in those 4 days. We certainly seem to now be pricing in a much more aggressive Fed. Tech has taken a tumble. How do you see the world right now?
Well, no harm to Alix, but I think it was more than just the last 4 days. I think it was sort of people woke up at the beginning of 2022 and thought, oh, my goodness, the world has actually changed. The Fed is going to not be at our backs. It's going to be, the wind is going to be coming at us on that front. And I think that all of a sudden, all of the things that we were surprised that nothing happened in the back of 2021, when it started to become clear that the Fed was changing its ideas about what they needed to do, didn't seem to rile equity markets at all. And now it seems as if everybody woke up and thought, oh, my goodness, we're going to have to do something about this. And this is going to change valuations. It's going to change multiples. And it's just going to change the way we look at equity investing over the next 12 months.
Okay, so what do you do? I mean, that was my question over the last few days. Like, as an investor and you're looking at this price action, the volatility, what do you do?
Well, to some degree, people already had started changing some of their positioning, at least we had last year. And we were never really all in on some of the very high valuation tech stocks to begin with. I mean, we own some technology, but I think there's going to be a bifurcation between those profitable companies that are huge cash generators and those that are struggling to generate any kind of cash. And I think in that environment, a higher rate backdrop is not particularly good for the ones who can't generate a lot of cash. I think that's going to be true across the board. I think valuations are finally, after quite a long period of time, going to start to matter. And cash generation and balance sheets are going to be very important as we navigate what is no longer a very easy Fed policy going forward.
Sarah, there's been this narrative over the last few days, while Alix has been out, I'd like to point that out just again, that we shift to value, that value is going to outperform. My question to you is, are some of these companies with strong free cash flow that look relatively well valued compared with some of the names that you've just been talking about, some of these tech names, are they going to outperform in absolute terms, or are they going to outperform in relative terms?
Well, I think it's more about valuation versus value versus growth, because I think that there has been an enormous amount of stretched valuations. We've been talking about it collectively for the last couple of years. And it's only when you start to see a change in the backdrop that that starts to matter. So I think that companies with reasonable valuations are going to be able to perform fairly well, but they're going to have to get that growth. It's going to have to be profitable. Margins are a huge question this year, and you're going to start to see where that differentiates. I mean, you've already seen a huge move in consumer staples because those companies finally have some pricing power. We were talking about pricing power last year. I think there are tech companies that have some pricing power, so I don't think it's a pure rotation out of tech and into pure value. But I do think that it's going to matter how people start to see earnings and how companies start to talk about earnings, and whether or not, as you've seen with some of the banks, that compensation becomes a bigger issue, because that's a much longer tail on inflation than simply supply chain bottlenecks, which is what I think everybody was hoping that inflation was about. But you've got a couple of different issues on the inflation side. You've also got energy prices, and I know that's near and dear to Alix's heart, but there's very much an issue going on right now with energy, and not having cheap energy complicates the inflation picture dramatically.
So then to that point, I mean, I feel like we're talking around tech at this point. We've seen a big re-rating, and I wonder if the earnings that we're going to get from some of the big tech companies like a Netflix today is going to justify the current valuation. Like, have we re-rated enough here?
Well, I think Netflix is a difficult one to start with because they've always had a pretty high valuation relative to the cash they were able to generate. They finally got to the point where they were able to do some, but they spend a lot of money on content, and that has not changed during the pandemic. So I'm not sure that they're the best bellwether for whether or not earnings are going, tech can turn it around, as it sort of said before the break. But I do think that you're going to have to see some growth in some of this tech. And if you don't see it, the fact that earnings are coming through is not going to be enough.
Just in terms of the baby in the bathwater in all of this, and Netflix trades at 39 times forward, which is still fairly punchy, even relative to where it was before. Do we see the baby being thrown out with the bathwater? What I'm wondering here, Sarah, is does even the good stuff go down in this kind of environment? It may outperform, but does everything go down?
Well, I think that the knee-jerk reaction at the beginning is to sell everything and to swap out of tech and into other things. The question is, what part of tech is then going to come back as people start to say, okay, those earnings are not so bad and we still need growth? And that's part of the problem with value, is that sometimes there isn't a lot of growth there with value as a whole as opposed to growth. So I think that there will be a knee-jerk reaction. I think you've already seen it. I mean, the top big mega caps have not been hurt as much as the underlying stocks in some of these indices. But I think that there are places where, I mean, we like a stock called Akamai. They do internet routing traffic, but they also have a security business that's growing. That's not at a crazy valuation, and I think that the security business is going to continue to grow. Does it matter in the knee-jerk first reaction when people just sell tech? Probably not. But you're going to see people come back to those stocks that can prove that they can generate cash and that there are valuations that are still believable in that they can grow even further. So I think that that's really, you're going to see some differentiation there.
For the stuff that's still in the bath, you mentioned it earlier, like energy, for example, up 16% so far year to date. Where would you be buying in the energy world when you're still looking at WTI at 80? You're looking at some super heavy call options in the triple digits. Where still has the value?
Well, there are some industrials that play into the energy sector. A company that we like is called Flowserve. They make a lot of the big valves that go into pipelines for both petrochem and for oil and gas, as well as other things that need big pipelines. I think there are some places where you can find that supply into the sector. Unfortunately, the desire to have cleaner energy has meant that there has been a sort of demonization of, hydrocarbons in a way that complicates the picture right now, because it's much more about politics than it is about the normal cyclicality of oil and gas. And right now that politics is sort of showing you that you're getting less supply at a time when demand is finally coming back and coming back pretty strong.
Hey, Sarah, it's always good to see you. Thank you so much for joining. Couldn't ask for a better guest on my day back. Yes, that's right. I was out for 4 days. Sarah Hunt of Alpine Woods, thank you very much. Coming up, Bank of America's latest results getting a good boost from clients who are taking on debt once again. We're going to have more with Brian Moynihan, Bank of America Chairman and CEO, coming up next. This is Bloomberg. Live from New York, I'm Alix Steel. Guy Johnson over in London. This is Bloomberg Markets. Bank of America stock is up about 0.5% over the last 2 days after bank earnings came out. You're going to benefit from a growing economy as well as those rising rates. What is in the future for the company? I want to send it right over now to Bloomberg's David Weston.
For our Bloomberg television and radio audiences worldwide, I'm David Weston, and we're delighted to welcome now the chairman and CEO of Bank of America. He is Mr. Brian Moynihan. Brian, thank you so much for being with us. You announced earnings this week, and one of the things everybody was interested in was loan growth. Give us your sense about where you are in loan growth, but maybe as important, where you see loan growth going.
Well, David, it's nice to see you again. And, so we announced our earnings, $32 billion in record earnings in 2021 for the company. The team did a great job delivering for their clients and shareholders and communities and each other last year, so I want to thank them publicly. But in terms of loan growth, we had $50 billion of loan growth in the quarter, not in the year, in the quarter. About $15 billion of that or so was in the markets business, which can ebb and flow, depend on securitizations and things like that. But 35 was core in the wealth management business and the commercial banking business and consumer businesses. And so that we see, what we told people yesterday is you should expect us to grow faster in the economy at probably upper single digits this year. And what's good about that is two things. One is there's tremendous capacity to borrow still in our customers, whether it's credit cards still $20 billion off the peak, or whether it's line usage by our commercial clients that was at 35, went to 25, now back up to 30, round numbers to give you a sense. So that means clients have an ability to borrow to keep the economy going. And then secondly, for the good of Bank of America shareholders, loan growth actually is a way we extract the value of this huge deposit franchise, and that's good for their earnings.
So, Brian, I've talked to some people in the industry, maybe not who run banks, but some people in the industry who say they think the opportunity in future loan growth may well be in the middle market, sort of the smaller and mid-sized businesses. The big companies have borrowed what they need to borrow, and consumers right now don't need it. Does that sound right to you?
Well, David, our global commercial banking business run by Wendy Stewart, and then we have two businesses which go to quote the middle market. A fellow named Raul Anaya runs business banking, which is up to $50 million in revenue, and Wendy runs up to $2.5 billion. Those businesses, Wendy's team, I think, had 8% loan growth for the quarter. Those are major corporate, middle market America. And so there's two aspects to it. We're seeing more demand for loans there. We're doing more with more clients. We're actually deployed hundreds of relationship managers over the last few years investing in the future, and they're now having success. But importantly, the second part of that is as people use those lines, that means economic activities going forward. So they are the window into America's sort of economic soul in terms of mid-sized companies and small businesses. By the way, in the all-important small business segment, which Sharon Miller runs for us, we actually have seen 125, 150% of monthly production, quarterly production compared to where it was before the pandemic. So not only have we gotten it all the way back, we're actually growing and creating more loans per quarter, which again is good for the economy, and that shows you the economic activity continues to pick up.
Brian, one of the drivers for your earnings that you announced this week actually were investment banking fees, up something like 26%. Investment banking mergers and acquisitions has been very, very hot in recent months. Do you see it continuing in 2022, or do you see it trailing off?
Well, Matthew Coder, who runs our large corporate investment banking business for us, not only in loans and cash management fees and everything, had a great year in investment banking, all 4 quarters above $2 billion, record numbers for us. The pipeline is still full. And, some of that was always is always market dependent. There was deals, equity offerings and stuff, whether they get pulled or not if the market's bouncing around. But the pipeline is more than full, and they had a great quarter, a great year, and the team has continued to drive good market share gains year over year, and we couldn't be prouder of them. But the reality is that revenue can come and go, based on market activity. The good news is we get a lot from financing activity, which tends to be steadier, but the advisory business, which is strong right now, will really be dependent upon companies making decisions to buy and sell and things like that, which right now is full in the pipeline, and hopefully it continues.
Brian, you know better than anyone, it's not just the top line, it's also the bottom line. You got a lot of credit for controlling expenses in the earnings that you announced. On the other hand, there's a lot of competition for talent when it comes to banking right now. You said that we will step up to the plate. You won't lose people you need to lose. Can you manage expenses effectively and still pay the top dollar that's really coming in for bankers now?
Yeah, I think if you think about the broad expense base, the team's done a great job over the last 12 years that they've been together doing it, to bring the expenses in the company down in line, get the efficiency down. And then, then frankly, the expenses rose during COVID, for a whole host of reasons, including the success of the more markets-related business revenue, whether it's the financial advisors in Merrill Lynch, the private bankers, and then the investment bankers and the traders under Jimmy DeMar's leadership. So, yes, those compensation levels have risen. But importantly, David, remember, we've also, in the last 2 years, gone from 20 to, first of all, accelerate our move to $20 an hour to start our wages to 21. We've increased the compensation of the company dramatically across the years. But how do you make that all work? Well, you keep engineering the company, keep working on processes to take out cost and reinvest it in the people you have left. So our headcount last year went down by about 2%, and that was just through the operational excellence we have, and we continue to do it. So we have a company that's a lot bigger now. When I became CEO, we had 300,000 people at the peak in my first year of being CEO. We now have 208,000 people. The company's bigger, has more activity, and that's just by the operational excellence, which everybody in the company drives. 2,000 ideas last year alone to make our company incrementally more efficient. So you take that money and you invest it back in clients, capabilities, and technology, and people, and pay, and that's how we maintain our competitiveness.
For our Bloomberg television and radio audiences worldwide, we're talking with Brian Moynihan. He, of course, is Chairman and CEO of Bank of America. And we're talking about banker compensation right now, and that goes really to the heart of what I was going to ask, Brian. One of the problems with wages is it's hard to cut them. It's easy to raise them. It's hard to cut them. It's not like prices for other things. How much of the compensation increase is baked into the structure for Bank of America, and how much of it, frankly, varies with what the income is?
Well, it's a tale of many cities in the sense that there are some businesses which have not as much leverage in them as they call it, so therefore their compensation structure maintains constancy. There's bonuses. Overall, we have about $32, $33 billion in compensation and related expenses, benefits, compensation, bonuses, et cetera, for our team of our $59 billion in expenses. So it is the biggest expense by a lot. And so the only way to really to manage that is actually how many people you have going through it. You have to be competitive. You have to pay people. We don't want people want to work for less next year. Now, if the equity markets drop, that changes the way the grid works and the financial advisory and the revenue comes down and the pay may go down. That is not something we ever hope happens. We'd rather pay people more and grow the business. So, there are parts that move that way. There are parts that don't move that way as much. But the reality is it's a multifaceted, complex discussion. But our job is to be fair, be a great place to work for all our teammates, and that's what we do with our compensation practices.
Brian, as we look forward into 2022, we're looking at something we haven't seen in a good long time, and that is the tightening of monetary policy rather than the loosening of monetary policy. Give us a sense of what you're looking at, and just to be specific, as you make projections at Bank of America, how many rate hikes do you expect out of the Fed in 2022?
Well, there are two parts to that. One of our research team led by Candace Browning-Platt, and the team is terrific, and they have 4 rate hikes in next year. But internally, we model our future income off the curve. We don't fool ourselves and let anybody make a projection. But look, inflation is here. The economy, is going to grow at 6.42. So think 6 in 21, 4 in 22, and 2. You get to the 2% growth rate in 23. And think of it this year as making that adjustment. That is based on the tightening, first the fiscal stimulus stopped last year, and now the monetary stimulus is being pulled out because the economy is as big as it was, growing faster, unemployment's below 4. The conditions are right to go ahead and actually reduce the accommodation, with one big caveat. Does this virus go in some direction that cause some damage that people don't understand? And the good news is, we're winning the war on the virus, the vaccines, and everything you know about. So, but remember, the key is that 6.42. The economy is slowing down, and part of that is the engineering that goes on to bring it into a more of a sustainable growth rate, because it was growing faster than it usually grows. And so, will rates go up? Yes. 4 times this year is a prediction. The reality is, does that help our earnings? Yes. But the real reality is that's to bring the economy, to take the inflation out of the system, and if they get it right, because the economy is growing very fast and inflation is growing very fast. As that slows down, we should get back to normal economy. And think about our economy being bigger than it was in 19 already on nominal terms, and predicted to grow at twice the rate. Of course, we have to worry about inflation, and that's why they have to raise rates.
What is your level of concern about a possible policy error? A lot of people are talking about that because the inflation numbers are rather alarming, including to Jay Powell, the chair of the Fed. And the question is, how much does the Fed have to intervene as opposed to how much they can take advantage of some of the things you're talking about, which is the economy slowing down on its own?
Well, I think the question is if we were sort of finally normalizing rate policy into 17, 18, 19, and that then they were able to do that, and the economy kept being predicted to grow at 2% or so, which meant that it was working, right? And now the problem is now they have to go through it again. Could they overshoot? The answer is absolutely possible. Do they want to overshoot? I guess the answer would be absolutely they don't want to. But the reality is this is trickier because the velocity of the change here, much different than we've seen. The velocity down and the velocity back up has been unbelievable. 30% down in a quarter, 30% back up, or 20 whatever percent, and then moving. And so that's the question. So could you overshoot it? Yeah, because this is a completely different set of circumstances going on. Underneath what's going on, too, think about inflation, the inflation aspects of wages you talked about earlier, but also think about housing increase in prices, think about goods increases, think about supply chain shortage. So it's a much trickier case than before. So I think the market expects them to raise it. The market expects them to keep that inflation above their target rate if they can, because frankly, it's taken a decade to get it back there. And so all that's kind of expected market. The mistake, the market will be worried about is worried about a mistake because it's tricky execution. Now, the key, David, is what's going on that we see. And our consumer spending, in the fourth quarter was much stronger than the third quarter, the second quarter, the first quarter, either over 19 or 20. You can pick your year last year. It grew at 30% over in December of 21 versus 19. Think about that dimension. Coming into January, it's still growing at double digits. So consumers are out spending money, and that's good for the economy. But also that means that you have to be careful that people aren't getting, it's just getting too fast growth and has to be managed, and that's what the Fed's trying to do.
Finally, Brian, what does the likely path of the Fed mean for Bank of America in terms of loan growth? I know you'll make more money if the yield curve steepens, but what about loan growth?
Well, we make more money at yield curve steepens because the nominal rate environment goes up, and we have $2 trillion of deposits and that are huge core deposits, and they hit zero floors when rates come down. That's sort of $6.5 billion, 75% short curve on the short end of the curve, driven by the deposits. On the loan growth, it's really going to come down to economic growth. So what I would expect as the economy normalizes, you're going to see companies borrow back up to the line levels they had in 19, which is 35%, and that'll drive another chunk of loan growth for us. And then if our teammates are as good in the market as I think they are, they'll get more customers and get more from them. But basically we always have thought that our loan growth should be slightly better than the economy, but largely, as the economy goes from a 6 to 4 to 2 growth rate, you're going to see loan growth more normalized, and we should grow at mid-single digits or better, which we had been doing before the pandemic, and growing a little bit and growing market share, but also just growing on a core basis.
Okay, Brian, really appreciate your time today. That's Brian Moynihan. He's the chair and CEO of Bank of America. Now back to you.
David Weston, thank you very much indeed. Fascinating conversation, lots to digest and think about coming out of that conversation. Alix, he talked a lot about the business. He talked a lot about the macro story as well. My sense was that Brian was thinking a lot about the rate of change here. Things went down very fast. They've come up very fast. The Fed is going to have to manage that. Rates are going to go higher. But this is a really difficult environment at the moment just because of the pace at which things are moving.
And the same thing really goes for comp. That's what I found most interesting as well. Obviously, compensation, the biggest expense for B of A, but would rather pay more people and grow the business. And that's sort of, I think, the theme is what we've heard from many bank CEOs. I guess the question becomes just how much more do you have to pay and how sustainable is that? Or how much faster does your business have to grow to offset that?
Absolutely, and this is going to be one of the real challenges. We've had to deal with the supply side shortages within the economy driving inflation. Does that now start to come into the wage inflation story? We've already heard from the banks that the answer to that question is yes, as you say. We don't know yet how sustainable it's going to be. I wait now for the rest of the earnings season. What are other CEOs going to be saying in the service sector, the industrials, etc., in terms of managing this story? And is that ultimately going to end up hitting margins? We're going to talk more about this next. Where does the economy grow? President Biden marking his 1 year in office today. Interesting press conference yesterday. We'll talk about it next.
Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. We are about an hour into trading right here in the U.S. Bloomberg's Abigail Doolittle is looking at the moves. Okay, we're getting a bounce, but I have to question how sustainable it actually is going to be.
Well, that is the question. Will this prove sustainable? Because we're looking at the best day of the year for the S&P 500. Many of these other indexes, you can see greater than 1% gains for the S&P 500, the NASDAQ. Take a look at the Golden China Dragon Index. A lot of those Chinese ADRs up about 5%. Its best day of the year as well. And then the Russell 2000, which is really in technically difficult waters, holding on to support by just a thread, or it is up also, up 1.1%. So after the intense selling, we're seeing some green on the screen. And of course, one area of relief. This was not the case yesterday, but we do, of course, have yields down for a second day. That 10-year yield coming in, not even a lot, down 4 basis points. Yesterday, yields were coming in, did not help out stocks all that much. But today, it seems as though investors looking at this as a bit of a tailwind so that we don't have to look quite as closely as liquidity coming out of the system and valuation. Not surprisingly, and also based on the fact that that NASDAQ 100 and that China index, China tech index in particular, up so much, we have big gains for some of the tech stocks. We have the likes of Microsoft up 2.2%, its best day of the year. Tesla up 3.6%. Baidu, these Chinese tech ADRs getting a huge lift. Some saying that KW Web, that K-Web ETF, that perhaps it has bottomed, up 5.5%. And Netflix, of course, kicking off earnings today after the bell. Right now, up 0.7%, but down an incredible 25% off of the November peak. A lot of analysts expecting the subscriber growth is not going to be what they were expecting 3 months ago, 8 million now. Some analysts, JP Morgan in particular, are looking for 6.25 million subscriber adds. So again, this stock up a little bit, but lots of nerves around what that quarter will mean. And overall, tech earnings expected to slow to 14% earnings growth for the fourth quarter, coming in from 40%. So let's put this together with the technicals. This is the NASDAQ 100. So of course, yesterday, the NASDAQ reached that 200-day moving average in a pretty serious way. You can see that over the last year or so, the NASDAQ 100 has basically been in this trend channel, more recently breaking it. However, hitting down on the support of its 200-day moving average. The NASDAQ 100, of course, is all those big tech names that we were talking about, so it doesn't have some of those smaller cap names. You can see the RSI, a momentum indicator, also starting to round up. The point here is maybe, and this is after a conversation from Steve Sosnick yesterday, that maybe instead of talking about buying the dips, we now need to start talking about selling the rips, because we do have lower highs here. So it's not to say that we're not going to go back up into that range, but maybe that would be a good time to take profits, Guy.
That's an interesting angle that we're finally coming around to. Abigail, thank you very much indeed. Bloomberg's Abigail Doolittle on the markets. We're an hour into trading over in the United States. Here in Europe, we're continuing to digest what is happening on the Russian front. We're thinking about what was said yesterday by the president over in Washington. We're thinking about what Emmanuel Macron talked about as well in terms of his approach to this problem. We're talking about Russia and Ukraine here. Antony Blinken, the Secretary of State in Berlin, meeting with some of his counterparts, making comments right now. Antony Blinken saying that Vladimir Putin, doesn't believe that Ukraine is a sovereign nation. The crisis is about Ukraine's right to be a democracy. Some argue that this is the biggest challenge to Vladimir Putin, a successful and democratic Ukraine. Russian aggression will only bolster the NATO alliance. Some are talking about joining it. If we were to see Russian aggression, certainly up in the Nordics, we won't solve the Ukrainian crisis at the Geneva meeting Friday. Remember, he's talking there about the conversation that he's going to have with Mr. Lavrov tomorrow in Geneva. This all comes, as I say, hot on the heels of the comments we had yesterday from President Biden, marking his first year in office today, but he delivered that press conference yesterday, and the real standout story was his comments on Russia.
But if they actually do what they're capable of doing with the force amassed on the border, it is going to be a disaster for Russia if they further invade Ukraine, and that our allies and partners are ready to impose severe cost and significant harm on Russia and the Russian economy.
what is that cost going to be? I think that's a question that a lot of people are trying to figure out right now. If it's a small incursion, does that generate a small response? A big incursion, a big response? We did have to have some clarification post-press conference from the team at the White House. Let's get further insight into what happened yesterday and what it means going forward from here for the rest of the Biden presidency. Ian Bremmer, president of the Eurasia Group and G0 Media, joining us now. Ian, always a pleasure. Just give us your takeaway on what happened yesterday at that press conference and what it means for Russia, Ukraine, NATO, etc.
Look, the United States is clearly preferring diplomacy over escalation on Ukraine. We've made it very clear to the Russians that there would not be any direct military defense of Ukraine if there is an invasion. They are not a NATO state. That was taken off the table by Biden, but he made it clear it was never really on the table. I think that's true. The allies of the United States are completely committed to a very tough economic response and a military response outside of Ukraine if there is a full invasion of Ukraine. In other words, tanks roll in, airstrikes, they take out Zelensky, the president. Having said that, and you saw this in the press conference yesterday, you saw it also with statements recently from the German chancellor and most importantly, the French president, that short of a full Russian invasion, the Americans and the Europeans are not as aligned on what kind of consequences would befall the Russians. And President Putin is completely aware of that. So, I mean, the Russians have always been more successful in operating inside the lines, in the gray zone, cyber attacks, little green men. I mean, you'll even remember they've invaded Baltic sovereignty and gone across the border and taken an intelligence officer. And the Baltic states didn't want to make a big deal out of that because they didn't want to end up at war with the Russians. So what happens when it's not tanks rolling into Ukraine?
Yeah.
But it's something short of that. I think what you saw from President Biden yesterday was a recognition of that.
So it's been categorized as a misstep. Does that mean it was not a misstep, but it was just reality and we can continue to sort of expect this banter to go back and forth?
This reminded me of when President Obama was asked about Russia back in the day, and he said, look, it's not a superpower, it's a regional power. I mean, it is true that Russia's only a regional power. Their economy is smaller than Canada's. On the other hand, if you're president of the United States, do you want to say that? Is that helping you? So I think it is. I mean, there's no question in my mind that what President Biden said at yesterday's press conference accurately reflects the state of play between the U.S., the NATO allies, and Russia. Did he say that in the most artful way that advances American diplomatic influence vis-a-vis the allies and vis-a-vis Russia? I'm not sure that's the case. And I think that's especially when the U.S. is so politically divided, when America's worst enemies are inside the country, as opposed to outside the country, just looking to score political points and look for any weakness. Then, I mean, you know, taking a quote or two and making it seem like sleepy Joe Biden, he's got oatmeal for brains, all of this. I mean, you saw what happened on social media. There's the big gotcha moment. Those gotcha moments, whether they're against Trump or against Biden, are not helping the United States globally. And that means that if Biden is less than extremely careful in what he says, there's more vulnerability.
Okay, we'll come to domestic policy in just a moment, if we may, Ian. I want to stick with foreign policy for just a moment and just get a quick thoughts on China. Again, realpolitik. We're not in a position where we can significantly downgrade the sanctions and the tariffs that have been applied. Is that just, again, a statement of reality? This is where we are. This is a great power conflict, and we're not going to back away.
Well, you can't disentangle this from the domestic politics. I mean, President Biden knows well that he lost votes in 2020 in the general election because he was seen as Beijing Biden. He was seen as too soft on China. And they will not let that happen again. And Ron Klain, the chief of staff, who's functionally the prime minister inside the Biden administration, is very clear on that with the staff. So that's why you have the U.S. leading a diplomatic boycott against the Beijing Olympics. That's why it's very hard for the Biden administration to move on reducing some of the tariffs, that the United States placed on Chinese goods during the Trump administration, even though we're facing inflation at a 40-year high. And one of the things that Biden could easily do, if it weren't for domestic politics, to reduce prices for the average American worker would be to get the Americans and the Chinese to reciprocally actually take those tariffs off. It's very hard to do in this domestic environment. But one thing I will tell you is that U.S. trade with China is going up. It's not going down. Most American CEOs and bankers that appear on your show intend to do more business with China as they move towards becoming the largest economy in the world, not less. And the Biden administration is very aware of both that reality and the deep interdependence of the American and Chinese economies. So when we look at those things together, you do recognize that we are not in a Cold War with the Chinese. The Chinese don't want that fight with the Americans. We don't want that fight with the Chinese. We're not going to cut off our noses despite our collective faces. And that's why the relationship between the U.S. and China is in a more stable place today than it was during that somewhat shambolic first meeting that occurred in the Biden administration in Anchorage between Blinken and Jake Sullivan and their counterparts in Beijing.
Ian, you mentioned that you can't sort of divorce international politics from domestic politics. And, you know, you mentioned inflation and sort of an easy, quick fix in some ways. An easy, quick fix would also be call up oil producers in the U.S. and say, pump more, gasoline prices have to come down. What do you think the Biden administration is up against when it comes to tamping down inflation? Build Back Better is great. Voting rights bill, okay. But what people really want to see is lower prices everywhere.
Yeah, and that's one of the reasons why you saw the release from the Strategic Petroleum Reserve, which was larger than most analysts expected at the time. It's one of the reasons that the Biden administration has put some pressure on OPEC Plus to produce more. So far, the idea of pushing the American producers to do more, frackers to do more, energy independence for the United States has been a step too far for Biden. Why is that? Well, because the Biden administration prioritizes climate change as well. One thing that they understand the Democratic voter base feels very strongly about is that that is a priority. Younger voters feel that that is a priority. So I think that that is an area of pretty significant tension internally in the Biden administration.
Ian, we're 1 year in. We're looking ahead to the midterms in November. We're trying to figure out what ultimately the result of that is going to be. But certainly, judging by current polling, the Democrats are going to lose and lose big. They're going to lose control of both houses. What does the second half of the Biden administration look like?
Well, you lose the House, you can't get legislation done. You lose the Senate, you can't get judicial and other appointees confirmed. You lose both, and it's unclear how you can ensure a free and fair election, assuming that Trump or a Trump appointee is running on the other side that doesn't get broken in terms of certification and doesn't become a constitutional crisis. So as we put in our top risks back on January 4th of this year, we said that the midterm elections in the United States were the most important in history, precisely because it represents a turning point in whether or not we have a legitimate election. And look, the fact is that if you want to have a democracy, a functional democracy requires national, free and fair elections that are seen as legitimate by both the winning and losing side. In the past months, you have had such elections, no problem, in Japan, in Canada, in Germany. In the coming months, you will have them, no problem, in South Korea and in France. You no longer can say that about the United States. President Biden made that clear in his press conference yesterday. The Trump presidents, former President Trump and his supporters have made that clear as well and continue to talk about the fake news of stopping the steal. This is a serious problem, both for the United States as well as for allies that count on the U.S. and adversaries that are looking to take advantage of American weakness.
Ian, you paint a very stark picture. It's going to be fascinating to see the development being played out. We'll get back to you with that as well. Ian Bremmer, president of Eurasia Group, thank you so much for your time. And of course, G0 Media, thank you. All right, coming up, the tech sell-off is taking a pause today. We're going to speak to Adena Friedman, a NASDAQ president and CEO, and many different things. But first and foremost, how tech's performance could actually affect their business model. What do capital markets do when you have this kind of move in tech just in the last few weeks? This is Bloomberg.
This is Bloomberg Markets. I'm Justin Morton, live in the principal room. Coming up, Barbara Lavernos, El Oriel Deputy CEO. That's at 2:30 p.m. in New York, 7:30 p.m. in London. This is Bloomberg.
January has been a volatile month for tech companies, and if you're long the NASDAQ, it's been really rough. UF Stocks has lost about $2.8 trillion from their market cap so far this month, and 53% of that comes from the NASDAQ 100. Well, joining us now to discuss her outlook for capital markets is Adena Friedman, NASDAQ President and CEO. The NASDAQ also released its 2022 outlook for capital markets. Each year, Adena releases it around this time. You can catch the whole thing on LinkedIn, and we'll get to that in a moment. It talks a lot about how capital markets will affect the sustainable future, as well as financial stability and fighting financial crime. Adena, thanks for joining us. We're going to break down all of that in just a second, but I think it's important to set the stage because the last few weeks have been very tumultuous if you're a long tech investor, and I'm interested into how it affects your business. Are there a lot of participants? How is it going to affect things like IPOs and SPACs? What do you think? What do you see?
Well, first of all, I think it's important to recognize that when I look at the capital markets, I always look at long-term performance, and of course, the technology industry has always and will continue to be a long-term performer that I think that is a bright spot in our economy. But I think that in the very short term, we're dealing with a lot of very dynamic environment, both in terms of the political environment, in terms of the economic environment, and then you overlay that the need for the central banks around the world to make some adjustments to their monetary policy. And I think that is really what's creating a lot of volatility. It's, investors don't like uncertainty. And right now, it's really the adjustments that seem to be forthcoming, or at least being predicted around some monetary policy changes that I think are creating that unpredictability for investors. In terms of the capital markets and what that means in terms of raising capital, we continue to have an incredibly strong pipeline of companies that are seeking to tap the public markets. If you look at last year, we had there were about 133 filings at the SEC for companies looking to come to market on NASDAQ. And when we look at that same number at this time this year, it's double that. It's about 250. So we have a very, very strong pipeline of companies looking to tap the public markets. The volatility in the markets might put a pause on that, but at the end of the day, when the windows will open, and I think we will see a very active issuance environment as we get into 2022.
Adena, it's Guy. First up, I think it's Netflix tonight, not not Disney. Loving the Baby Yoda, though, behind you. Very nice.
Thank you. The Mandalorian and Yoda, yes, indeed.
Absolutely. We'll look forward to those Netflix results. Let's talk a little bit about what happens in the near term, though. Do you expect a pickup in volatility? What does that mean for volumes? Do you expect in the near term, to Alix's point, that we are going to see some of these listings being pulled? Just as we watch the dust settles, how long do you think that process is going to take?
Well, we've seen periods of volatility for many years now, but I would actually point to since the beginning of the pandemic, because different industries are affected by the pandemic in different ways. You overlay that on top of that, a very, very significant monetary action that was taken at the beginning of the pandemic, and then you overlay on top of that the global supply chain challenges that we've had that I think have been exacerbated by the pandemic, and you create a very dynamic environment. We've had episodes and periods of volatility throughout the last 2 years, and we're going into 2022 with a new period of that. But we've also seen periods of great performance. We've seen more involvement from individual investors in the markets than we've ever experienced. And so you have this incredibly engaged investor base, a very dynamic economic environment, and you have the potential for changes in monetary policy. And I think those three things are just creating a more volatile environment right now. But I also, we've been managing through that since the beginning of the pandemic, and we've had record number of new listings and capital raised to the public markets. We had, if you look at the U.S. in total, it was almost $300 billion raised into the public markets last year, 180 billion on NASDAQ. So we do feel that there continues to be a very active and exciting pipeline of companies looking to come.
Well, and that sort of brings you to the report that the NASDAQ published. Like I mentioned, you can check it on LinkedIn page. The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing. I do think that it's really important to recognize that when we think about the environmental, social, and governance impact that companies can have, it's very, very significant. And the financial system and the capital markets can be a great solutions provider to corporates as they're making their transitions. The transition to a net zero carbon economy is a very, very significant undertaking. There's an estimate that in order to be able to meet the Paris Accord obligations in 2050, we're going to need something like $150 trillion of investment. So that is why the capital markets play such an important role in helping companies transition through that.
Adina, it's the Wild West out there, though. Is this going to be the year when we finally start to get some clarity on what exactly ESG is? There are rules, but nobody quite knows exactly what they are. When does that start to stabilize? Is it this year, or are we going to have to wait?
So that is actually a big point of our piece that we published today, which is we really do need kind of global regulatory framework that we can operate under when it comes to transparency around ESG. How do you define carbon output? How do you make sure that we can only manage what we can measure? So if we come up with some more common measurements that companies can provide to investors and that regulators can say these are the key measurements that we need to be focused on in order to meet the net zero obligations, I think that the commitments have been made, the path is set. And now it's a matter of making sure we have the transparency that investors can rely on, and we have the, I would say, an organized way for corporates to be able to manage through this through a framework, a common framework globally. This is a global problem, so it requires global collaboration.
We hear you. Adina, thank you very much indeed. Adina Friedman, NASDAQ President and CEO, plus the Mandalorian. Thank you very much indeed. This is Bloomberg. 33 minutes of the European close. Let's talk about the price action. Stock 600 up by 0.4%. We do still have a negative German 10-year, negative 2 basis points, nearly 3. We're also watching what is happening with the Russian ruble. We'll talk about all of this in the next hour. The close is coming up. This is Bloomberg.